One of the most enjoyable things that I did all summer long was going go-karting. Like everyone that goes go-karting, I thought I was really fast, I thought I was flying, but I was still about 20% slower than the fastest lap times out there. I did it up in Queensland. It was hot, it was noisy, it was risky, there were twists and turns, and there were opportunities as well. And I think about that, and it's very similar to the equity market right now. It is noisy, it is hot. How do you manage all of these risks? So that's exactly what I want to talk about today, equity investing in this noisy world. And there's three key things I'd like to go through and try and keep it relatively simple in a forward-looking approach. The first one is valuation. Whether it's an index, whether it's a stock, you get a return either because the valuation goes up or because the earnings go up, or both of those go up. It's really simple. The second one is, if you're invested, what are the risks? What should you be thinking about with your portfolio? And what are the opportunities as well? And then finally, just to keep you to the very end, I'll run through one of our exciting new additions to the portfolio, a recent addition 3 months ago. So keeping it simple, it's all about valuation, it's all about earnings, it's all about risk. So if I start off with the barbecue question of the summer, are global equities expensive? It's been a great couple of years in the sector. And if we look at the data, the largest individual market in the world, the US, the S&P 500 up here, you go back 20 years, the forward price to earnings ratio was at 17 times. 10 years ago, it was at 17 times. Looking today, it's at 22 times. So from a headline level, you'd say, well, yes, it is expensive there. But despite this, you've got to think about it in conjunction with earnings. Valuations have risen, but if you think about the earnings growth potential, right now, that is very high. And again, this is broad aggregate figures, the consensus of all the analysts out there in the US and the world. We do that same chart here. Go back 20 years, earnings growth was forecast to be about 9%. And I've taken a 2-year forward number here. It's about thinking about the medium term, so trying to avoid any cycles that might have been forecasts. 10 years ago, it was 11%. Right now, in the US, there's 13% earnings growth forecast. And that's a big step when you think about valuations. Now at Firetrail, we're fundamental investors. So what's behind this? And if you look at the individual stocks, what's driving it? You've heard a lot about AI today. It's both through the efficiency, it's also the spend that's out there. That flows through to earnings. Things like healthcare, GLP-1s, Eli Lilly, Novo Nordisk, there's spend going on there. Interest rates. People often forget that about 15% of the world's index is financials. And if you're a bank, when interest rates rise, you can get more interest income. That flows through to earnings as well. And then CapEx as well. CapEx to sales ratios are running at decade highs around the world. Companies are spending because they think there is a return to be made. So fundamentally, it looks like there are reasons to be optimistic and that these earnings growth expectations are realistic. So they're strong there. Let's put it all together, valuation and earnings, and put it together for the whole world. The MSCI World Index, so all the developed markets in the world up here. This is a peg chart, or price to earnings versus growth. If you had a company on 20 times PE and it had 10% earnings growth, this ratio would be about 2. You can see it's averaged about 1.5 over the last 10 years. Had a bit of COVID noise in there, but the really interesting bit is this right-hand side. So a 47% return in global equities in the last couple of years, but the line has stayed flat. That means that the valuations, the earnings, it's all been justified fundamentally. So overall, there's a reason to think that there's a fair value global equity market out there. Now, that's great from an index perspective. What about if we could dig into that? What are the risks? The first one is quite obvious. Earnings could be wrong. All these analysts, us, we could be wrong about where earnings are forecast. That's something that we've managed through having a concentrated portfolio. But the more important one, I believe, is this one right now, and it's about your factors. It's about your styles. Growth, we all know, it's done exceptionally well over the last couple of years. It's won 7 out of the last 20 years, but the MSCI Quality Index has won a lot. The Value Index has won too, and cyclicals have won. No one of these styles, no individual style, will win all of the time. So be aware of where you're invested there. How do we manage this at Firetrail and the Global Equities Opportunity Fund? We look forward 3 to 5 years, and we're looking for companies that are adapting to the future. And there's two styles of companies we think about. It's what we call future leaders, where it's about 2/3 of the portfolio, excellent opportunities, valuation upside, earnings upside, typically more mid-cap in nature, more undiscovered by the market. There's also current leaders where earnings are being underestimated. Now, regardless of whether it's a future leader or a current leader, all businesses within the portfolio have to fit into 3 characteristics. A robust business model, surviving, actually thriving on a 3 to 5 year view. Sustainable earnings, sales, cash flows, we forecast all of that fundamentally. And then finally, so important right now in this noisy world, adapting to change. We spend a lot of time with company management, divisional management, competitors to assess, is this company adapting to the world as it is? So it's a concentrated forward-looking approach. And if I open that up to you, what are some of the recent opportunities that we've added to the fund? In health, there's names such as ICON. It's a clinical research organisation, one of the largest in the world, and to bring a new blockbuster drug to market now costs billions and billions of dollars, and you need help from companies like ICON to go through all those clinical trials and research. It's trading at multi-decade lows in terms of valuation. On innovation, technology, AI fits within this bucket, but our biggest contributor over the last year has actually been interactive brokers. It's up 145%. It's growing its customer numbers 30%. It's got the best tech stacks, the global banks are using it for their back office systems there. And it's also got that interest income benefit as well. Climate, so much noise, Trump, politics, regulation, but that line of the world getting hotter, that's still going. So we're invested in names like Train Technologies, Fortum, which is a baseload power generator, and Schneider Electric. And then efficiency. Everyone's looking for ways to make their jobs, their lives easier. AutoZone can get 1 million parts or auto parts to mechanics in the US within a day. Provides a great job there. Now, I told you I'd talk about one high conviction opportunity, and it's one that's a recent addition. We've only just held it for 3 months. That opportunity is a stock that fits all of the buckets I've talked about. It's innovative because it has to be. It's in a tough industry. It's got pricing power. It's raised its prices for its key products at twice the rate of CPI for the past 30 years. Dominant market share, 60% share in both the US and Europe. And it's a cyclical, near a low point in its cycle. Finally, what's so important with all these customers is saving customers time and money, making their lives easier. Now, the stock's been around a long time, 188 years. The stock is John Deere. This is Annabelle here at the Deere headquarters over in Iowa in the USA. We added the stock to the fund in November. Now, I'll dig into a couple of things with this stock. The first one is innovation. You hear a lot about these things, Tesla's innovation driving around, autonomy, and that's great, but we think something really exciting is actually the top left there. Imagine that. Imagine sitting at home watching your lawns being mowed. You're doing nothing except just watching. It'd be fantastic. Useful as well. But in all seriousness, agriculture's ripe for autonomy. 60% of their earnings come from large agriculture. The average farmer in the US is 58, getting older, does 12 to 16 hours a day of work. Labour's getting tougher to find. Deere is solving all of these issues for them right now. They're the only ones that can do it. They're the only ones that can spend the money out there. And then the cyclical nature of it, the agricultural cycle. It's been pretty tough for agricultural commodities, corn, soy. Corn's the biggest one there, but we're seeing signs of life in the past 6 months. That means farmers' balance sheets, their income is ticking up, and they're able to invest in new kit from companies just like Deere. So there's tailwinds to earnings growth for John Deere. If we put it all together, how do we think about it fundamentally? When we go through the numbers, you've got 14% earnings growth every year out to 2030, a great 5-year CAGR. It fits all of those investment criteria of ours, It's in the Miski World Index, but it's also quality, it's value, it's cyclical. You've got buybacks, you've got dividends as well. And valuation, the price you pay is so important, 13 times price to earnings when you look out at 2030. So it's a high conviction opportunity, and this time next year, this is the one to ask me about. So that's today what I've talked about, equity investing in a noisy world. The Firetrail S3 Opportunities Fund, we've been listed on the ASX since October 2022. We're now managing around $750 million, a 64% return there since listing on the ASX. The three key points today: valuation, so important to think about, but think about it in conjunction with earnings as well. It's risky out there, where are earnings going, but also be aware of where your styles are as well. And we manage that by being across styles. We're not taking style risk, we're taking risks in stock-specific opportunities. And I talked about John Deere, a high conviction stock. So that's how we think about things at Firetrail. We try and keep it simple. We look forward, we think about valuation, we think about earnings, we think about the risks out there in the market. So thank you very much for sticking around, and thank you for listening.